welcome to my own FP. In this video, we're going to start looking at charts. Previously, we have Mary and Harry Cherry. We entered all their data. We looked at the grid and how to manipulate the grid. So now we're going to go over and look at charts. And just like in the main grid, you can switch between Mary and Harry and joint. You can go between real and constant currency dollars. You can highlight any line or bar on the grid at any point in time, so you can just simply see that. You can download the grid or the charts to a PNG file, and you can view the grid or the chart in a grid format as well. And then once you view it in a grid, you can also download that to a CSV. Some of the charts we'll look at we'll have a summary style chart, and then we'll have a much more detailed style chart. And then for some like investment accounts, you also have a cost basis showing up on there as well. So now let's go into our system and look at charts. This is the main chart view panel. So you can see these are gross income will be a summary. This is a detailed one. This tax is the summary. Then there's a detailed one. Taxable income, net after tax, and surplus are kind of all related, so they're kind of all together. You have a liabilities by account, and then all the liabilities, RSP by account, and then all the in-out information. So these are all sort of the middle columns as you go to the right are more detailed, mostly than the ones on the left. So that's kind of that aspect to it. Let's look at a really simple chart. Let's just look at tax for now. As we said, you can do Mary, you can do Harry, you can do joint. They don't look that much different because they have very similar account values, which is great in retirement especially. So their tax that way they pay is not going to be significantly different. So a lot of times we'll, in all of our views, just look at Mary because in this scenario they're very similar. You can look at it in constant dollar terms. So you can see your taxes here are relatively the same over time. Then at 75 we go to a different expense rate we moved from 90,000 to 84,000, so the amount of money that we have to pull out is going to be less. And then after 85 it's less again, and at that point we also run out of our non-registered account. So we're still paying some tax because we're pulling out of our RSP, but we're also taking a little bit out of our TSA, which is not having to pay any tax on, so our tax bill goes down from then on. So you can see every 12 years little bumps at 61, 73, 85. These are due to the tax that we have to pay, taking money out of our RSP for a car. Again, you can set that up slightly differently so it comes out of your TFSA or out of cash or something like that. So as I mentioned before, you can select let's go back to let's put them all on. Okay, let's start again. Okay, let's now look at how we can highlight different parts of the grid. If I click on this button, if I just go to the button, it'll show and it'll start highlighting it. If I click on it, it'll remove it. If I double click on it, it'll only show that one. So let's add them all back in again. If we want the Canada one, we want to just see the Canada one, we highlight it, it'll show it all. When we click it once, it'll remove it. If we click it twice, it'll show it. So now we can see that without the BT tax, because now we can see it on its own based on the zero line, which makes it maybe a little bit easier. And then we'll add the BC tax, and we'll add the line of the overall tax value. On the actual, if you move up into the grid, you'll see there's a tooltip, which at 80 BC tax is 1,330, shows the value. Our Canada tax is 26,44, and our total tax is 339.74. So that just shows you very quickly what you can show on the grid. The grid icon here will show this in grid format. Again, we can switch between area and joint and real and $24. So those are different options that you have. If we click on the picture icon, we can flip back to the chart again. This icon will download the chart to a PNG file. This icon will just expand the grid slightly, so if in some charts it's a little harder to read, you can just expand it to take more real estate on your screen. And obviously you can close the chart. Okay. So that's the main summary of how to navigate charts. Next, we're going to start looking at some key charts: gross income, tax, assets, investment categories, net worth, estate, and cash flow. Let's look now at some of these very specific charts that we want to look at. Gross income is always important. And we're going to look at this in Mary, real dollars for now. And you can see these are our streams of income, not worrying about the type of income. So some comes from our CPP, some comes from our OAS, employment, RSP, pension transfer, and whatnot. So we work for a couple of years, we buy a car, we get some money out of RSP, some non-registered. We retired, so now we're taking a bunch out of our RSP or RIF, however you want to manipulate that. Then we start taking a little bit less once we start taking OAS and CPP. We're still taking some out of our non-registered accounts. Non-registered here means non-registered plus cash, because those are two non-registered account types or categories. And then we start taking less from our RSP because we have OAS CPP as we go along. But we're still taking a reasonable amount out of our non-registered. That's, again, a choice that this particular set of rules has made. And then later on, we take it more out of our TFSA. So this ends up as a very flat tax strategy, because you take your RSP and if you're going to live to 95, you want to pay a little bit of tax all the way out. You don't really want to be taking only from your TFSA at that point in time if you were going to live there. If you think you might not live all that way, you don't want to be paying as much tax early on. So it's always a little bit of a gotcha as to how much tax you want to pay early and how much tax you want to pay a little bit later. So this ends up, as we saw in the tax chart, it dies down over time. So that's not necessarily a bad strategy. When we see CPP at 70, you'll see we take more out of our RSP early. And that's so this chart, if we use these arrows, we can go left and right. So let's go right to the next chart, which will be our gross income by type. So this is very much like the other gross income, except now for CPP, this is now going to be income. In this case, it's only one. CPP, OAS, employment, they're all the same. They just have income. RSP, let's just put both of those on. Some as income before 65, some as pension income. We also have pension income transfer. So this came from Harry because he had a defined pension plan and he wanted to contribute back into Mary's to even out their tax bill. So you can see that's pension income, and you get that a little bit before 65 because it's his pension income for Harry. There's a way. There we go. To get it all back. By triple clicking, you can get it back. Sometimes it's a little bit ornery. It doesn't always do it. Anyway, so in our non-registered, let's look at non-registered category. We have cash, which is return of capital. You don't get any thing there. You do get cash income. So that one is hard to see. So let's click that on. And so that only goes up to 65. We get our income. The return of capital will also be there. So we're taking a lot of return of capital out in our cash for those first couple of years because we're not taking as much from our RSP as maybe we should. That's a choice. Okay. Non-registered account, We have capital gains, dividends, and return of capital. And in some cases, we're at the very end here, we're taking some of our TFSA. And then our gross total. Again, you can see the tooltip. So that's gross income and gross income detail. Tax rates. There's lots of other charts that are by different accounts, contributions, fees, government benefits, whatnot, whatever. We're not going to go through all of them. We looked at the tax one a little bit before. Tax rate details. So tax rate details gives you, for example, BC. So this is the BC tax you're going to pay. There's no additional things there, but if we look at all the credits that you're getting from BC, we can click all those on. You're getting personal credits, pension credits, EI credits, dividend credits, CPP credits, and age credits at various points in time. You can see the tax that we pay is bumps in certain years. So it's very similar to what let's go one more to the right. And here's your tax rates, your marginal rates and overall rates for BC. So your overall rate for BC is that. Let's take a look, 4.9, 3%. So that's pretty flat for our BC rate. If we look at our overall rate for Canada, it's this line here. So it's relatively flat at 6% for the years between 72. Then we buy a car. It then drops a little bit to 6, high 5s, low 6s. So that's also very flat with what it was before. A little bump on the car. And then we start taking more out of our TFSA, not that much from our RSP. And we start going down over time, sort of thing. So that is what Mary's tax rate would be. If we look at joint, the tax rates will be the maximum as opposed to the average in this case. So we just want to see what is the maximum tax rate between Harry and Mary. That's what you'll end up in the joint one. So, their overall tax rate looks very much like what Mary's did. Now it's 9%, 8%, and 6%. So that is just very similar. And that was Harry's rate. Mary's rate is just slightly lower than Harry's rate. So that's because he has this defined benefit pension plan, and then because of pension transfer, it ends up being almost exactly equal between the two of them. Okay. So our overall rates end up being, that's our overall. This is probably the one you look at more often than, marginal rates or other things that are per province. It doesn't really matter that much. Your overall rate for Mary, 9%, 8%. If I go to Harry, 9.5%, 9%, 8%. So they're very similar. So it's not a bad plan, other than maybe the car issue there. It's, do I want to pay more tax or a little bit early and keep and put it more into my TFSA, or keep a little bit of my RSP to keep paying tax all the way along? That's always going to be the question. Okay, other ones we want to look at are the investable assets. So this tells me how's my RSP sort of faring over time. So it goes up, it hits its max at 60, which is just before we started retiring. We retired at 61, and we started taking some money out right at 61 because we needed to buy a car. And then that goes all the way back down to 95, our non-registered in cash. So this is by account type, not category. So you'll see that starts depleting down to the point where at 78, I think there's a tiny maybe a bit there, 77. And then most of our money at the end of our life is in TFSA. Everything sort of moves over towards that. This looks very similar for Harry and Mary, and joint obviously looks pretty much exactly the same as that. So it's good when all your accounts are balanced between each spouse. Everything works out really nicely. You can just divide everything up, and you pay the lowest tax rates. So it's quite useful. Next one, so we'll look at property accounts aren't really that exciting. We paid that off. It's a negative just because it's a liability. There's no RSP accounts. Overall by type or by category, more specifically, we can see what our investable assets are. So this is your investable assets are your RSP, your TFSA, your non-registered accounts, LIRAs, lifts, and all that if they applied. These are more lines because investable assets includes non-registered and TFSA and RSP, so they can't be stacked in a bar. So that's our investable assets. Our liabilities started off negative, went to zero as we paid it off. Our net worth looks very much like our investable assets. If you look at those, they're very similar. If you look at our TFSA, it's a smaller portion up front, and then goes to pretty much all of our net worth is tied up in our, or all of our investable assets are tied up in our net worth, and then our property is the remaining portion there that comes into that. So if you want to look at our RSP, it looks very similar to the other chart. Maxes out at 60, and then we start declining it after that very quickly for 60 to 64 because that we're not taking CPP and OAS. Then we start taking some CPP OAS, and then we start having more minimums that we have to do. So we have to take out a significant amount more as we get into 74 plus. So that is overall by type. Our net worth shows you just by the overall investable assets, liabilities, and properties. Those are your main three categories. And so that is very similar to what we've shown in some other reports. And our estate, at the end of the day, is this shows what comes into your estate, for example. So let's look here. Our home is tax-free. It's 9.5. Let's look at this in joint. Our home is tax-free, 1.9 million. Our taxable portion of our estate is going to be 800,000. Of that, we're going to have to pay $330,000 in tax if we died at 2024. And our home mortgage is 110,000, so we're going to have to pay that off as well. A couple other things on here would be we had some return of capital from our non-registered accounts. That could be cash. It could be some part of your stock portfolio. That's return of capital. If a capital gain or thing would have to go into this, capital gain would be in this estate taxable portion. Your RSPs will be in this taxable portion. Let's just see, what is this one here? They're tax-free sort of thing. So if we look at these two, this is pretty much what my taxable income is for each year. Ideally, you want that to not be so high. Hopefully, you're not going to pass away, in these ages of, 72, 73. If they are, then if you both pass away, it's going to be a lot, sort of thing. Of course, that is what. Let's just look now at one person. So if one person passes away before 72, you would have $442,000 in taxable income. You'd have to pay $156,000. Now, that is also part of our total residual at that point in time is going to be $2.2 million for that one person. So they're paying 5% of their estate in tax at that point in time. Some of that's house, some of it's whatnot, some of it's TFSA. Okay, so return of capital is tax-free from our non-registered accounts. Our home's tax-free. Our home mortgage is there, and on the negative side, and these are the sort of taxable portions that we have to pay. So that is your estate residual. Obviously, the most interesting part is what is that line? If you look at that line, it's very close to the top, so we're not paying any tax really at this point in time, or very little. Like, so if we're 90, our tax bills would be 85. Our taxable thing is 85,000. I can't actually get the, where's our tax? You know, if we pass away after 85, we're only paying about $42,000 in tax. So that's not a bad plan, even though we have some amount in our RSP and whatnot still at that point in time. But it's not a crazy amount of money that we're actually having to pay at this point in time. So that's not a bad plan. So that is exploring charts. For the most part, there's one different type that is very different from the others, cash flow. So let's look at this in terms of joint. So if we look at it in our 2025 year, we have a lot of employment. It goes to an employment type of account or category. Then as we get towards gross, we want to know what type of income source it is. So it's income. So it's going to just regular taxable. Some of it's going to be dividend if it comes from non-registered or non-registered accounts, dividends, capital gains. So this is your normal, while you're working, you have employment, some income, some dividends and whatnot sort of thing. So this cash line here went back up, so it becomes part of this income line. And then we have that much in gross. So as a couple, they paid $92,000 in expenses. If we move that to 2024, it'll be $90,000. The various payroll taxes that we have to pay, deductions and that, their TFSA and RSP contributions as a joint couple, their loan payments, and how much tax they paid overall. And then we had $15,000 in surplus, and that went to our cash account at this point in time. So we did save. So the color-coded things you save are in green, things you pay are in liabilities are in yellow, and other things that we pay to the government are in blue. So as we sort of move forward, these years are the same as we have. We're working. We were not working. All of a sudden, we have employment and RSP contributions. On the right side here, we have basically very similar to what we had before, except we had this car expense that we had to pay. So that's one of the reasons why this year is a little bit higher than other years. And as we sort of go forward, let's go to a year where we're paying government pensions. So you can see government pensions are in blue. Government's always blue. Either you get from it or you receive from it. So you take a large amount of your RSP, take a large amount of your defined benefit pension plan, government pension, and a certain amount from non-registered. Of this non-registered, some of it's going to be capital gain and dividend, so that you couldn't do anything about that. This return of capital means that we had to pay. We sold some portion of our account to pay for additional expenses in this particular year. So now, again, your rules can change. So you can take more out of your RSP, less out of your non-registered. That will end up draining your RSP significantly faster, which we'll do another video on it and show how that works and how it changes. So that's our cash flow. You can do a custom chart. So if I click on custom, and I'm just going to do account with multiple borrowers and a couple accounts, we're going to do our cash account and our CPP account. Just as an example, you can do whatever you want. We're going to look at the cost basis and by account, and then we're going to show that. Right now you can't save these. That's what this add chart eventually is. You should be able to save these and have them show up as custom ones that you want. So this just looks like any other chart that you had. If I get rid of CPP, and I get rid of the total, then my cash account here this is what it is, and my cost basis is basically the same as what the total is. It goes into cash, I pay the income on it, and the cost basis is going to be the same. If I add the CPP in later, we see what that is. I don't know why I put these necessarily on the same chart, but I just randomly selected that. So you can see, of course, Mary, Harry, you can do all that. You can put in a grid. You can do whatever you want and take a picture of it. So that's a custom account or a custom chart. You can do it by in-out transactions, what came into that account, what came out of that account. You can get the contributions and things like that. You can aggregate source accounts into types, and you can ignore the return type in some accounts. So there's just different options you can play with. So that's charts. In this particular scenario, it shows, good things, bad things with your scenario, and then you have to determine, what rules you might want to change going forward. So thanks very much. In our next video, we're going to look at what are we going to do in the next one? I think we're going to take a look at taking CPP at 70, and then we're going to do a comparison of two scenarios, which will have more charts. And there are a couple different new ones in the comparison, so it's quite interesting to see how the two different scenarios compare. Thanks very much for watching, and we'll see you in the next video. Thanks.